welcome. I appreciate you taking the time to visit with us as we talk about participations. A little background though first, if you don't mind, just a few moments. njBIZloan Connection is brought to you as a co-partnership between the NJCUL Services Corporation and Biz Lending and Insurance Center. Today we're gonna, hold on one second, there we go. So today we're gonna talk about participations, and when Jim and I began talking about this presentation, we realized that there's so many intricate parts of participations that we could actually probably be talking here for hours, and boy, this is dry enough material anyways to get through 45 minutes that we didn't want to, we tried to determine what would be the best approach, not knowing exactly who our audience is. So what I meant by that is some of you credit unions here might be active in participations. Others that have logged on with us today have never even been part of participations. So what we decided to do was create a more beginning generic approach to participations on a broad level, and then sometime in the future, if we're invited back, which we hope we are, we can drive the next presentations down to specifics and particulars. And we'll expound on that a little bit more as we get into the presentation. So allow me to introduce myself. My name is Murray Halprin. I've been in the credit union space now since the beginning in the 1990s, so that's quite a long time. I'm the managing director of njBIZloan Connection, and with us we have an old friend of mine, an old associate of mine, a business associate, Jim Janota. Jim's going to be speaking a little bit later in the presentation, and Jim's going to drive down a little bit and be more specific. What I'm going to present is going to be somewhat more generic. Many of you might know what I'm going to talk about. I apologize for making you go through that. Excuse me. But I think you'll find a lot of this quite interesting. So let's get started. Who is njBIZloan Connection? And then we'll get into participations. I think I already mentioned this. We are a new and exclusive service for member credit unions of the New Jersey Credit Union League. We are a partnership between the Service Corporation and the League, and our clients are only League members. So we're really happy to have this exclusivity with the credit unions in New Jersey. So we're going to ask to begin this with a couple of polling questions. There's going to be 2 polling questions, and the reason we'd like for your participation, no pun intended there, in the polling question is so we get an idea of who our, who our audience is. So the first polling question I'm going to bring up in a moment for you is, has your credit union bought participations? And if so, please check, you'll be able to check in a moment, the ones that you have bought. The next question is going to be, have you sold participations? And of course, please check all that apply. So I'm going to pull the poll up right now, and I'm going to launch the poll, and I'm going to ask for all of you to answer the first one. You'll be able to scroll down, I believe, to the second one, and I'll give you a minute or so and for you to answer those while I continue balancing the portfolio participations. We've been involved in many different types of participation offers, buying and selling in our history, and one thing I've found, the active credit unions who really do their due diligence and spend their time on participations end up having better yields and lower delinquency ratios. So it is kind of interesting how that works. So I see 2 of you, 7 of you already voted. Thank you for those 2 that have voted. We're going to give this another few seconds there, and then I'm going to move on and get the presentation going. Thanks for your understanding as we get through the preliminary parts of this. Give another 10 or 20 seconds and we'll be ready to go. All righty. Hopefully you've all had an opportunity to read through these. So let's get into the presentation. Hey, Andrea, technical difficulty. There we go. It won't move forward, Andrea. Any suggestions?
Did you share the results are shared. So it was 100% student loans for the first question, has your credit union bought participations? And then for the second one, has your credit union sold participations? It was 50% student loans and 50% other.
Gotcha. Yeah.
So now we're finished with that, and now you should be able to go forward.
Yeah, it's not allowing me to move forward.
Your screen is froze. I apologize, everyone. Is your screen frozen, Murray?
Folks. It seems to be, yes. Oh, there it goes. Now it's moving.
Okay,
all right,
perfect.
We're back in business. All righty. Thanks, Andrea. Sorry, everybody.
Welcome. I apologize, everyone.
All righty. So let's start off with why balancing of the credit union's portfolios. Here's a number of reasons that I get most of the time when I'm talking to credit unions and we're sitting down and most of their loans are in auto loans and they're not yielding enough to cover expenses. Many of them are taking on additional risk to drive more yield to increase the revenue. And they're doing that by noticing that there's higher unsecured credit card balances, which is great for yield, but it gets them a bit of nervous. And any of this makes sense to you out there, well, here you go. They want to find a way to create more fee income. And if you've not done this in a while, it would be our recommendation right off the bat to have a complete portfolio analysis to sit down and really determine if you can reposition some of your loans to help increase yields. And we're happy to discuss all this with you. So this is pretty trite, but I wanted to go over it. And NCUA's definition of what is a participation. And many of us might not have read or heard about this, but let's talk about it for a few moments or so. A participation is a loan. Participation is a loan where one or more eligible organizations share the risk associated with the loan by purchasing a portion of the loan from the originator or lead lender. This is the most important part of all this, and we're going to discuss this in detail throughout, and Jim's going to get to this in a few minutes in detail. As with all loans, you must conduct a proper and thorough due diligence, and the due diligence begins by addressing your policy, agreements, your risk assessment, and monitoring processes. And we're going to really spend a lot of time today just on that. So, what are some of the benefits of participations? Let's review that. You might know this already, but let's talk about it. And again, Jim's going to drive into all of this. So if you want to be a seller, you'll be able to, what are some of your advantages? Well, originate versus denying a loan. You might get a loan that comes in that might be larger than you would normally fund. Or if you're nearing your cap and you don't want to commit any more cap towards that cap, how about buying that loan and or selling some or all of it to others to facilitate your system and to facilitate your member. By offering and selling participations, you're generating premiums and servicing income. You're retaining and maintaining membership relationships, most important to all of us, and you're distributing risk with other lenders. You're purchasing credit unions. You're going to grow your number and size of loans, generate interest income, and diversify your risk by diversifying your loan portfolio. So remember some of these premises. We're going to drive down in a few moments on those. So if you don't and haven't bought participations or sold, let's go over a few of the basics of how you would need to start a participation. This might be review, but it's good review. So we're going to discuss the NCUA Rules and Regulations, Section 70122B5. Credit unions must establish a written loan participation policy. Many credit unions get a boilerplate policy and they think that's sufficient. You really need to put one together, let your team look at it, send it off to your corporate counsel, make sure it's done with reference to what your needs are. And that's the following here. The policy should include what you want for underwriting standards and due diligence expectations tailored to your comfort level for risk. This means that your credit union, not the originator, should determine acceptable standards for collateral, loan types, documentation, expectations, servicing agreements, aggregate and single borrower participation limits. Jim's going to expand on this, but this is the beginning, the first thought process, and the first steps if you don't have a participation program in place. Well, there's some basic responsibilities that I believe that all of us and every credit union should begin to consider. How about the individual credit unions? You're expected to evaluate the original credit union's financial condition and loan performance record. You want to make sure you're buying participations from a credit union that's got a very strong member business lending or auto or other portfolio, that their history with their credit they put on their books is strong, that their department is efficient, that whomever's managing the selling of participations from that credit union has a strong background and a good history, so that originator or lead lender, whomever you are going to determine to buy from, the credit union must, your credit union must do your due diligence on that credit union. By reviewing the lead lender's due diligence background, you might want to do that through an outsourced third-party qualified party. So instead of just accepting their credit criteria, have somebody review it. It's mandatory to have it reviewed, and make sure at your credit union who you have people on staff that understand what you're buying and understand from that third party what that credit memo looks like. Therefore, that group who's going to approve this participation, you must document your credit and risk analysis. So relying solely on the other credit union, the lead credit union's credit memo is not sound business practice. Please don't do that. It will get you in trouble, I can guarantee that. So while your credit institution is assuming the risk associated with these products, the last one here, engaging in a loan participation has to deserve the same consideration in evaluating risk as other loans and should meet your credit standards. In fact, I would suggest that buying a participation, you should exceed your credit standards, just so you're going to be putting strong, good opportunities on your books. So the second step is, once you've put together your participation policies, procedures, defined your underwriting standards, things of that nature, how about a participation agreement, especially if you're seller? So the rules require, and I'm going to read this, that all loan participants be supported by a written agreement between the participants. So what does that mean? The agreement has some specifics requirements. You got to specify the loan information, such as participants and amounts, information on the interest portion retained by the originating lender, the location and custodian of the original loan documents, condition necessary to gain access to financial and other loan performance information. And by the way, I can stop right here on this. Many QSOs that sell participations and many larger credit unions that also sell participations have some very good, I'm going to call them Dropbox systems in place where all this information should be available for you at all the time. This way you're not having to call and always request. So whenever you're buying, specifically I'd be looking for that type of system in place. information on the borrower and servicer, and information on the duties and responsibilities of the parties involved in the participation. I want to talk this line right here. Let's talk about the servicer. In the credit union space, most credit unions outsource servicing either to their QSO or to a third party. It's vital you understand what system or learn what system that servicer is using, and maybe get an idea of what the system's capabilities are. Ultimately, it can help you from reporting function and information from the whole participation. So now, once you've put your policy, procedures, guidelines together, especially if you're a seller, you've got your participation agreement together. If you're a seller, you should also have a participation package, information about your credit union, your credit union's ability to manage and sell participations, your credit risk approach, complete package so buyers can get a pretty good feel of who your credit union is and what you do and how you do it. Specifically now for the buyers of credit unions, what are you going to do once you start buying? What are your ongoing requirements? It's important you consider these and think about them. So your loan participations require ongoing risk monitoring and risk management appropriate for the type and level of risk the loan poses to the credit union. So the lead lender, the originator in many cases, should conduct annual reviews. Those annual reviews should be posted or delivered to the credit union so you can review what they've done with regard to monitoring that credit. You should have somebody within your credit union as a buyer who knows how to read and understand these annual reviews, review them, and write up their own information about it. If not, I highly recommend that you outsource the review of the review, how do you like that, to a third party, and then somebody within the credit union documents that you've reviewed your participation annual reviews and you've come up with the proper determination if it's performing properly. So that's just what the second line is saying here. Credit unions should perform regular reviews of the financial condition, business environment, and operations of the borrower and principals involved, and continue to work closely with the originator or lead lender and request any information necessary to remain fully informed of the risk associated with the borrower. From experience, one of the things that I've noticed that I believe we need to have more of are especially for commercial real estate and for more of the larger commercial real estate deals, are annual site inspections. Many credit unions need to get a little better at that, and it should be something you want to make a special note if a recent site inspection was done of that property and what the person doing that report views the condition of the property as with regards to how it's supposed to be maintained. Usually before things start going bad on a deal, the property is neglected, and it's a good indicator of what's happening. Which leads me just into this slide. That was the segue, as you can imagine. Oh, sorry about that, folks. Let me dismiss that. So it's important to learn as much as possible about the originating lender. It's just like if you're making a member business loan, you're going to learn as much as possible about your sponsors, your borrowers. You're going to want to know everything about the property, the collateral. You're going to want everything that's out there you want to learn. I suggest you do the same thing about the original lender. The servicer. I would get to know that servicer as well as possible and what their capabilities are, because bad servicing can create a real headache for everybody. Other participants. Many credit unions won't, they all should give out who the other participants are. You might want to call a few if you're new to that lead lender, find out if they've bought any other participants in the past through that source, and get a good feel for it. Understand and agree with participants' obligations. So in the agreement you're going to be getting, understand what your obligations are with the servicer, with defaults, what obligations you have, if any. Usually the lead lender manages all that. Some credit unions are comfortable with that, others aren't. Decisions on foreclosure. Usually the lead lenders makes that decision, but there are some agreements that you can negotiate with that. And collections. Yep, you're going to want to make sure who's going to handle collections for that lead lender and what their background is on doing that. And this one, this is a tip that we learned a long time ago. Whomever at your credit union is going to be responsible for these buying of participations, make friends with the person they will be working with at the originating lender. It just seems to help a whole lot if you've got that open line of communications. So I'm going to turn this over now. Jim's going to dive in a little more on this. Let me just introduce Jim. Jim is our participation specialist. He knows far more than I'll ever know on participations. You're going to hear the premise of lending from him about buyers and sellers, types of participations and comments, regulatory compliance, and then we're going to conclude, open it up for questions and answers. We're sorry this is heavy, not with graphics, but with talk, but we're passionate about this. Jim, welcome.
Thanks, Murray. Good morning, everyone. As Murray said, my name is Jim Janota, and I am the Director of Consumer Loan Participations for BLIC. Much of what Murray had spoken of really ties back to the commercial side, so we're going to come at this from a little different angle. We can begin with the premise of participation lending. And as you all know, competition is having a profound effect on the number of direct auto and mortgage loans being funded by many credit unions these days. Because these are major finance categories, a growing number of credit unions have found loan participations to be a suitable method of supplementing their usual lending practices. So it's not out of the ordinary anymore. There are several advantages to buying or selling participations through your league affiliation. Most importantly, your credit union will be provided with the tools and expertise necessary to buy and sell loans in a safe, sound, and compliant manner. Furthermore, there is no need to add additional staff, system upgrades, or make any other significant changes when utilizing this lending strategy. And finally, today's participatory environment requires higher levels of due diligence regarding, well, as Murray pointed out, and accurately so, regulatory compliance, vendor management, cost containment, overall portfolio risk than in the past. As such, our team will provide complimentary consultative services to those league members that are in need of them. The benefits of buying high-value participations are many. In particular, credit unions can increase their outstandings at will, which has proven to be a highly effective means of balance sheet management. Additionally, buyers may be able to dictate some of the characteristics of the loans being purchased, such as credit quality, collateral type, LTV ratios, weighted average of remaining maturity, which is a very important piece. These and other key elements help to mitigate both ALM and concentration risk. By reducing the number of loans held in portfolio, a seller, on the other hand, can redeploy the proceeds into higher yielding loans, capital enhancements, and or the ability to manage concentration limits and interest rate risk. Furthermore, income is generated by collecting an acquisition fee, which is known as a premium, and a monthly fee for performing loan servicing. Another attractive feature of servicing is the seller is able to maintain and retain relationships with the borrowers in the pool This is really important when you're purchasing or selling, in this case, a direct pool made up of direct loans rather than indirect for auto, for example. Let's talk a little bit about what I like to call getting ready to get ready, the buyer's readiness to buy. Again, and some of this may be redundant, my apologies. I know that Murray had touched on some of these things, but has the buyer ever bought any participations? If not, we begin by talking through the buyer's current circumstances and then move on to what the process entails. Is a buyer able to accurately calculate the value of the subject loan pool? This has a bearing on the price that obviously the buyer would be willing to pay, and that price, again, is known as a premium. It's hugely important, and it affects the net yield. So we help out there in trying to deliver accurate analytics to assist the credit union in, once again, understanding the value and the willingness to pay the price to obtain the pool. Does buyer have the experience to determine the safety and soundness? Well, some of the metrics used to calculate that safety and soundness are credit risk, speed of repayment, that is a huge piece, asset quality, and many more things that we can go in at another time, go into. Have buyers' loan, investment, and board policies been updated? Again, Murray just talked about this a few minutes ago. If they haven't, we will, on a complimentary basis, assist you in bringing your policies up to compliance. So we'll talk about that more at another time, but just know that even if they're not, we can help in making you ready to buy. That's another piece that you need to have to be ready to buy. What are the advantages to off-site and on-site due diligence? My recommendation, we strongly recommend that first-time participation buyers will visit the seller physically on site, and what I like to call kick the tires, meet the people, look at the loan files, get to know the originator and how they do business. It's an important step. It's kind of a third check in the checklist after you've gone through the offering and pricing and all that. Then you really want to meet the people behind the scenes. Add to the fact that servicing in particular is key, and we're going to talk about that more in a few minutes. Is the buyer comfortable with auditing a sampling of loan files rather than the entire pool? Because of the number of loans that a pool generally contains, $2 or $3 million worth, perhaps more, I think the general rule of thumb is perhaps carving out 10 to 15% of those to use your time wisely. And we can talk about how to choose those loans if you have not done it before. And it will give you a pretty good feel for the quality and the yield once you've completed that audit. Also, it will give you some idea of how closely the seller writes their business, writes their loans pursuant to their guidelines. Are the seller's loan policies acceptable? They may be different from yours. So you need to look at those and make sure they can mesh, that you're comfortable with that. And finally, are the seller's servicing methods and reporting capabilities adequate? We will touch on this again on the next slide. So Murray, if we can get there, yeah. Okay, now we're talking about the seller's readiness to sell. And to begin, does the seller have an accurate gauge of the loan costs, i.e. dealer incentives on indirect and the cost of capture on direct? Now, this is an important part of establishing the premium cost that they're going to charge the buyer as they're trying to recoup their costs of origination. So if you're a seller, we are going to work with you in order to identify those numbers and make or offer a pool that's correctly, well, let's say correctly put together in terms of cost and quality. Does seller have a thorough understanding of the value of the loans being sold? That may sound like a layup, well, sure, but the weighted average coupon is affected by sizes of loans, corresponding interest rates. If for a seller who has not assembled a loan pool, we will work with you to show you how to do that in order to once again accurately price the asset that you want to sell. And again, has seller updated the loan investment and board policies? We will, in fact, help you with that if needed. On the buyer side, by the way, there is not only the board policy, but there is reporting that needs to be done, and we share that, accounting tips and other things. Is a due diligence package available for inspection by the buyer? Murray mentioned this, and we can share with you sample due diligence packages that contain the information needed to be concurrent with the reg and to get the information you need, obviously, to make a decision as to whether you want to do business with this credit union or not. Is the seller prepared to carry out all servicing responsibilities, deal directly with borrowers on all matters, and answer for all legal and compliance issues? Most of the time, for a consumer product anyway, the seller will be or the originator or seller will be the servicer. And as a result, the servicer has to be able to take care of the business just as you would. They are responsible for every part of that. That is their job. That's what they get paid for. That's why you pay a monthly servicing fee. Now, with that said, and we'll get into this in a future slide, there are percentages in terms of income, losses, and things of that nature that you share. But the point is, you need to be very sure that this seller has the ability to do all those things, because they stand between you and the borrower in all compliance issues. Okay. Sample auto loan pool analytics. These are just some of the things that we look at in order to come to a net yield, meaning the yield, the coupon, the losses are baked into that. The stickiness of the loans, meaning how long will they remain on the books? When did you buy them? How mature were they when you purchased them? There's a lot that goes into this. However, here are some of the main analytics that we look at. Average original balances, we show those lowest and highest balances in the pool. And this is for the purpose of the seller to provide to the buyer so that they can see all this. And then the buyer then will take these numbers and rework them or scrub the data, if you will. Average remaining balance at the time of purchase, weighted original rates, okay, the lowest rate to the highest rate, weighted average original remaining terms and ranges. Again, that's how long we anticipate these loans will be performing on the books. Weighted average LTV, FICO, DTI, and the ranges, that's credit risk by and large. Weighted average days past due. Many credit unions will look at loans and they will carve them out if they're 30 days past due or longer, some even up to 20 days past due. You have that right. You have the buyer has that right. We look at the average model year, a mix of new and used. If in fact generally it's most pools are more heavily weighted and used because the factories are very adept at taking the majority of the new loan financing due to 0% financing and so on. And then at the bottom, and we do some other things to get there, but we deliver to the seller the net yield, and that includes the cost of acquisition, loan servicing, estimated losses, and other things. We've created a summary sheet to define what other things are, so we will address that at another time. Types of participation. The predominant type of a participation is a non-recourse between the buyer and the seller. However, the buyer would have full recourse. Let me jump back a second. Non-recourse simply means you buy it, you own it. If there is any recourse, and in this case there is, in two circumstances, excuse me. One is if the loan should default due to fraud, or because there was a deviation from the policy guidelines that were in place when the loan was originated. So that's what I call limited recourse. Beyond that, you own, as it says in the next bullet point, both parties are required to own a portion of these loans. You are not lending the originator money to continue to making loans. You both own a piece. And generally speaking, it's a 90-10 split where the buyer owns 90% of the UPB, which is the unpaid principal balance, and interest coming off the loans. Also, 90% of the losses. We do calculate losses from empirical data from the seller and what the market does. We have a number of different ways to calculate that fairly correctly. And excuse me, and so that part of it, once again, is very important, obviously, because of, at the end of the day, you're going to want to try to match that net yield that was calculated at the beginning of the transaction. More on that later. Loan types eligible for purchase, and this is written right from the reg, includes loans currently made to members of the buyer or loans the buyer is empowered to make. So that simply says if you want to buy auto loans and you're making auto loans, you're in business. However, if let's propose that at one point you were making student loans, you don't make them anymore, but you'd like to get back into that business, and you have a policy and you are empowered to do it by your regulator, you can buy them, even though you're not making them at that time. You can buy a pool. Consumer loans, the most popular are direct and indirect auto, guaranteed future value auto, which is sometimes known as balloon note financing, motorcycles. Some credit unions have an appetite for those. recreation vehicles. On the real estate side, you'll see conforming and non-conforming residential first and second mortgages. Difference being, excuse me, conforming mortgages are saleable on the secondary market. Non-conforming are not. The difference between conforming and non-conforming is very small. Generally, non-conforming mortgage loans for sale have very, very high LTVs, very low debt to income, or I beg your pardon, very, very low LTVs, very low debt to incomes. And so the credit unions, when they make these loans, will tend to use different techniques to assign value, such as an AVM, for those that are familiar with those. That's an automated valuation model, rather than a full-blown appraisal. And a lien search, or an augmented lien search, versus a full-blown insurance policy. So that saves money for the originator, and it also has a positive effect on the rate for the non-conforming. And these are very valuable loans if you have an appetite for these. Home equity lines of credit are very, right now particularly, they're very favorable. And the reason for that, obviously, is because they adjust at certain points, and they kind of keep up with the interest rate environment that we're in now. Home improvement closed-end loans are another superstar when it comes to delivering yield. They lead the mortgage, the real estate side. They're smaller loans. They are full recourse. Unlike all the rest, if a loan defaults, it goes back to the originator in full, and you suffer no loss whatsoever. The yields on these loans right now are north of 4%, and that's net. So, okay, so we get to everyone's favorite, due diligence and compliance. There are 3 due diligence levels that need to be examined. Those are vendors like ourselves, both participation partners. It's obvious that the seller is going to want to look at the strength of the buyer. Sometimes the buyer has the same, or the seller has the same feeling towards the buyer, the seller does, because they want to make sure that they're not using this strategy to keep their head above water. And so that's why they talk about both participation partners and the loan itself. Usually that's only the buyer. We've already teed it up. So the buyer is going to want to, what we term slice and dice this pool and pull out the information they need to make a decision. The subject of the NCUA's letter of 120 is due diligence over third-party service providers, which would be us. Due diligence review, that's what the seller will provide to the buyer. And there are some controls that are specifically mentioned. For example, in many cases, the maximum loan pool that a buyer can purchase is $5 million. They can go beyond, or 100% of net worth. They can go beyond that, but they have to have the regulator's blessing to do so. The other items down below, excuse me, are speak to the evaluation of loan participation programs. Once again, the due diligence package, what should be in there. And finally, they guide you on scrubbing the data, actually looking at the loan files, and assessing your own buying risk. How far down the credit ladder do you want to go? It has a very positive effect on the yield. However, buyer beware. And finally, We have provided loan servicing and negotiating services to credit unions in the loan participation market for over a decade. We work with a group of experienced buyers and sellers who have transacted billions of dollars of loans in auto, mortgage, and other asset classes. None of these have ever been criticized by regulators or outside auditors. As a result of our experience, we've been able to simplify the buying and selling of loan pools so that credit unions of all sizes and appetites can participate with confidence. And at this juncture, I'd like to thank you for your time and attention. But before I turn the presentation back to Murray, I'd like to also invite you to consider continuing the conversation so we can learn more about your specific lending goals and objectives, and perhaps discuss how a consumer loan participation may assist you in accomplishing them.
Thank you, Murray and Jim. We will go ahead and take some time for questions now. Just a reminder, please be sure to type your questions into the question box in the Q&A option in the control panel.
Well, while you're thinking of questions, I want to thank you all for attending today. Participations can be dry. And Jim, thank you for taking your time. And if you do have any follow-up questions, you can reach out to either one of us. We'll be more than happy to answer your questions. We always want to thank the folks at the League, Andrea, Robin, David, everybody at the League. All the credit unions in New Jersey are lucky to have such a strong league, and it's important as we collaborate throughout the state. So,
thank you, Murray.
There's wait, I think we have a question, Andrea.
We do.
Yes. Andrea, you will be posting a copy of this presentation, is that correct?
Yes, I will email the slides for the presentation, and it'll also be made available in our members only section of our website.
Great, thank you, John. Wonderful. If anyone doesn't have if there's no additional questions, thanks again, Andrea and Jim, and I think we're going to have another presentation coming up in a month or so. I forgot what the topic is, but look for us on the njCUL schedule, and again, if you have any follow-up, let us know. Thank you, everybody. Have a great day.
Great. Thank you. We appreciate you being here. A special thank you to Murray and Jim for your time today. This webinar was recorded and will be made available for your reference in the members only area of our website. The presentation slides will be emailed to you once they are made available. As a reminder, we have a scheduled series of educational webinars on Tuesdays at 10:30 a.m. Please be sure to visit njCULservices.com and check under our events calendar for the full list. Thanks again for joining us today, and we will see you next time.